This is CFA Level 3 and I'm going to discuss the equity portfolio management. We will start our discussion from this topic, that why we put equities in a portfolio. Equity, if you see the nature of equity, it served as historically it served as a good inflation hedge, because inflation is really a disease and it fatally affects the mechanism of portfolios and investments. Equities serve as a negator to this inflation mechanism. Inflation can be priced into stock and inflation can be passed to the customers, and equities in that case always serve as a hedge against the inflations. In contrast, some other asset classes like bond, they have been a very poor hedge because it's very difficult to change the terms of the bonds and transfer the load on the customers. It provides a growth dimension to the portfolio. Ideally, when we develop the equity portfolios, we have certain strategies to follow. Starting my discussion with passive management. It goes with low expected active returns and then low tracking risk. Opposite, we have active management, high expected active returns, and on the other hand we get high tracking risk. These are some strategies. In terms of IPS, we have passive strategies that will recommend, it's recommended in certain situations. If you and your client is one of them, you should adopt a passive strategy. One situation could be that these are taxable, and you are looking for low portfolio turnovers. Then it has an informational disadvantage. Maybe investing in informally efficient large cap markets, you want to avoid the high transaction cost in the small cap markets. In that particular scenarios, you are absolutely correct if you choose the passive strategies. In terms of active strategies, they are usually ineffective when incorporating the trading cost because of its high levels. We can give an index to equity for certain weighting schemes. It can be a price weighted index, like a consumer price index numbers that we use in economics. We have already discussed. We compare with the base year against any possible current year or any year that we want to make a comparison. We have value weighted index, that is for free float adjustment market capitalization. We have equal weighted indexes. In terms of price weighted index, sum of all security prices in the index divided by an adjustable divider. It may have certain biases. Higher price stocks will be overrepresented. In that case, it will not be factual. Sometimes a stock representation will change through time. It will be impractical, of course, for weighting schemes for most of the portfolios. In terms of value weighted index, sum of the total market capitalization of all the stock in the index divided by the previous sum and multiplied generally by 0 to get a percentage. In the same scenario, you can have biases for a larger cap, possibly mature, and maybe overvalued firms will be overrepresented in this case. Maybe less diversified and may contain a free float basis when you are going to use the value weighted index. When you are going to use the equal weighted index, it will be focusing more on uses return rather than the prices. So it will be less volatile and more predictable. The average return on all stock in the index multiplied by the previous value of the index. There could be certain biases in favor of small cap companies based on their smooth returns, require costly rebalancing, and it contains potentially illiquid assets and stocks. Well, what are the methods for passive investing when you are suiting for this option? The first method is you will follow index mutual funds or exchange traded funds, that is shortly called as ETFs. We can have like investment in separate or pooled account equity futures. These are more popular but has definite life, so it must be rolled over the period of time. For equity total return swaps, tactical asset allocation and tax will be used as advantage. So it depends upon the situation you are into and what is suitable for you. You can choose these methods. In terms of index mutual funds, we trade less frequently, and ETFs trade throughout the days. In comparison, they require shareholder record keeping, pay lawyer licensing fees, and then the ETFs, and are less tax efficient. It may have higher existing cost, that is fee and taxes. So you can see the pros and cons. Separate versus pooled accounts. Pooling has advantage, especially when the funds are smaller. It's difficult to differentiate performance of pooled account because they are mixed into. Maybe you may have to hold excessive cash based on undesirable cash tracks. This is what we can do. Comparable like equity futures, growth has been fueled by the portfolio trades. We can put baskets, program trades. It facilitates portfolio risk management. It's very liquid when trading low cost. We may have disadvantage, it must be rolled over due to the limited contract maturities. In terms of equity total return swaps, we should have ability to add equity returns to the portfolios. For example, like add equity index return to the market neutral strategy. It could be tax efficient way to gain the equity returns. For example, like gain exposure to the foreign entity without incurring withholding taxes. This will be a nice move. In terms of indexing portfolio methods, the first thing is it should have full replication. We can use stratified sampling based on the concept of strata, which is we have discussed in quantitative methods. We should work on the optimization, because optimizing the resources is really an important task. In terms of full replication, all the stock are indexed, are purchased. Most appropriately when they are less than 1,000 stock in the index, they are really liquid and manager has ample funds to invest. What could be the advantage is low tracking risk, and they are very less frequent rebalancing. In terms of disadvantage, it can be cost is the biggest disadvantage in such scenarios. In terms of stratified sampling, we can have a market cap, industry, style. It can be one or two or more dimensions. Number of stock in index should be large, and the stock should be liquid. Advantages, of course, is a lower cost, and disadvantages, it has higher tracking errors. In terms of optimization, use a factor model to match the factor exposure of the index. The advantage of this is accounts for the covariances between the risk factors, lead to tower tracking risk than the stratified sampling. Disadvantages: changing sensitivity, skewed sample data, frequent rebalancing. This can be important to consider in mind. In terms of equity investment styles, the value is the most important thing. Low price, multiple stock, you have to see the growth factors, stock with high expected earning growth. And in terms of market orientation, like resembles a broad market average over time, maybe either value or the growth. All these styles can be market cap based, it depends upon the situation. We have to bring value in investing. In terms of value investing, the first thing is rationalize, expect earning and price to revert upwards. Value stocks are safer than expensive growth stocks, and because it carries a value inside intrinsically. Risk is the stock is the cheap for the reason, and there must be a reason for the stock to recover. This is the risk associated with this. In terms of rationale, of course, for growing, investing, high expected earning growth will drive the stock price up even higher, and in terms of risk, the stock price may fall.